Hi, very good afternoon to everyone. I am Chirag Joshi, the Chief Growth Officer at Samco. On behalf of the whole Samco Mutual Fund team, I would like to thank every one of you present out here today for joining us, taking out time. We really appreciate and value this a lot. Today, we are here to launch Samco's ELSS Tax Saver NFO. The NFO opens on 15th of November and closes on 16th of December. Today, along with me, I also have the very dynamic Viraj Gandhi, the CEO of Samco Mutual Fund. Post the presentation, we'll take up Q&A in the end via the Q&A section. And I would request Viraj to take forward this presentation and take us through the Samco's ELSS Tax Saver Fund.
Thank you, Chirag. Thank you, everyone, for your time and patience. And I will try to make sure that I do justice to the time that you are investing right now in middle of the market hours. As Chirag rightly said, we are coming up with another NFO. During the course of my presentation, I will let you know more about it. But before I begin, as you all can see my screen, a storm is coming. But before I begin, this is a statutory disclosure that I want to make, that during the course of my presentation, I'm going to use a lot of stock specific example. They are neither a recommendation from our side to buy, neither a recommendation to sell. It is only for the purpose of giving an example to put forward a particular point of view in a particular direction. So I'm only going to use the names only for the sake of giving you an example, not a recommendation from our side. So as you can see this particular screen, it is very, very difficult to identify out of this screen which ship will give us more wool. And that is exactly where the mutual fund industry looks as on today in this particular segment of ELSS. Now, why do we say this particular thing is because there are 39 schemes in the ELSS category which are live. And if you can see this particular screen, the majority of them has an holding of approximately 70 to 75% towards large cap and very limited towards mid and small cap index. And if I take out the name which I've done in this particular segment, it will be very difficult for anybody to identify which scheme belongs to which particular AMC. So as on today, there is 1,50,000 odd lakh crores in the ELSS category in this particular segment, out of which 72% is towards large cap, 18% is towards mid cap, and 10% is towards small cap. If I put this in perspective of Nifty 500, which is the TRI benchmark index, 77% is towards large cap, and a meager 23%, the balance 23% is towards mid and small cap index. Now, out of that, the data is even more skewed if I take out the first 15 holdings of this particular ELSS scheme which are available in the market. If you see these names, this 15 names approximately makes 35 to 40% of their holding. So out of the 70% large cap, this 15 names has the majority holding, and typically the weight towards these names are more or less same for most of the scheme. Now, why are we showing you this data is that India as a country, India as a script on the global economy was a mid and small cap 35 years back, 3 decades back. And that's why we have seen a 20% kind of a CAGR return for the index in this particular segment from 1980 towards the 2000 levels. But for the past 10-20 years, more particularly for the past 1 decade, India is now been considered as predominantly a large cap index in the global scenario. And it is the growth story which everybody is talking about and which everybody wants to be invested into. Now, India, when it was a Bharat, during this period of time, gave good returns. And now India being India, you are not expecting, and it is anybody's guess as to what this number will be for the next decade, which we don't see it to be at this level, which will be somewhere around 10 to 12% kind of a return for the index as a whole. So giving an index specific portfolio to the client can expect no differentiated results. And that's why what we believe is that the next strategy of stock picking, the next level of stock picking, where we can see a lot of wealth that can be created for the client, will be into the segment which are still considered to be Bharat when India has become India and have the potential to become the India story. Yes, you heard me right. We are looking out for a mid-cap name which are category leaders in their own particular segment, which has the potential of becoming a large cap over the course of its period. So what is our solution for this particular situation that is there in the industry as on today for particularly for the ELSS tax saver fund, I'm going to share with you a video which is right now available on all social media, print media, even on the television network, and that is our solution for it. So after playing this particular video, I will take you deep dive into the solution in detail.
पेश है अगला द्वंद्व दो प्राणियों के बीच। पहला प्रतिस्पर्धी हाथी, दूसरा प्रतिस्पर्धी घोड़ा। दौड़ दौड़ होगी।
इन दोनों में ज्यादा तेज कौन लगता है? फिर सारे पैसे हाथी पर क्यों लगाएं? इसी तरह इन्वेस्टमेंट में घोड़े यानी छोटी कंपनियां भले ही सफर में उतार चढ़ाव हो, हाथी जैसी बड़ी कंपनियों से ज्यादा तेज भाग सकती हैं और ज्यादा पोटेंशियल भी दिखाती हैं। टैक्स, अगर घोड़े में इन्वेस्ट करने के साथ टैक्स सेविंग भी मिले तो? जी हाँ, पेश है सैमको ELSS टैक्स सेवर फंड, जो आपके लिए वेल्थ बनाए इंडिया की बेहतरीन स्मॉल और मिड साइज कंपनीज में इन्वेस्ट करके और ELSS द्वारा टैक्स भी बचाए। आज ही इन्वेस्ट करें। म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
Yes, so as you rightly saw during this particular advertisement that we have created for our ELSS tax saver fund, it is going to be ELSS fund that is going to predominantly invest only in mid and small cap category, which is not available in the market today. Yes, you heard me right. We are coming up with an ELSS fund which is going to invest only in mid and small cap index, and there will be zero exposure towards large cap. Now, why is this a particular solution from our side? Is because if you see this particular criteria, when we compare it with a Nifty 50, which is predominantly a large cap index with a mid cap and a small cap index, if you have a 3 to 5 year lock-in period, this is the data which shows that over a long period of time, if you hold a mid cap and a small cap index, it typically tend to outperform the large cap index by a very, very big margin. And this is the exactly what we have seen in the calendar year return from 2006 till 2021, where mid cap and small cap index has most of the time frame have outperformed the large cap index by a very, very big margin of, and there is an 8% alpha also available. So what we are saying is on a 3-year rolling basis, because it's a 3-year lock-in product, on a 3-year rolling basis, the return that we can expect from a mid and small cap index is closer to 49% compared to a 40% in return over a Nifty 500 TRI index. But what about the volatility? What comes in our head is that जब हम mid cap index में invest करते हैं, when we invest particularly in a mid and small cap company, there is a lot of volatility, and that is true also. But that is true only if it is a 1-year product. If you see, this is a rolling return, and see the volatility in this particular chart. If it is a 1-year lock-in period, and that's why this is very, very volatile in nature. But if I have to consider a 3-year return, a 3-year lock-in period return, and we see a 3-year rolling return in this particular segment, if you can see the green line, the volatility subsides drastically because it's a 3-year lock-in period. And that's why what is more important is that in an ELSS category, the client that invests in an ELSS category has no option but to say invested for a 3-year period. But what MFI data shows us that for any other product, 50% of the investor exits in the first 2 years. And that's why providing a mid-cap index for an ELSS category is the right match. And that is where we can see a very, very high return on capital employed business, where you can see a very high risk adjusted return for the client if you invest in a very high return capital employed business from a mid and small cap index and with a 3-year lock-in period. That is a solid combination. But for that, one need to be very, very careful in selecting the stock that you want in your particular portfolio. Now we have seen multiple times that a lot of mid caps has destroyed a lot of wealth, and a lot of mid caps have created a lot of wealth. Now, how do we identify them? Is by having a simple 3E strategy that we are going to follow, in which the first step of the strategy is to buy very, very efficient companies which are passing our Hexasil framework, which is our own proprietary model, on which there is a very, very famous with that most of the mid cap that you are going to invest, most of the small cap that you are going to invest are all kachra stocks. Now, let me clarify to you that that is not true. A lot of mid and small cap names that I am sharing on your screen right now are category leaders in their own particular segment. If you see a company like Page Industries, it's a leading premium innerwear company. Kajaria Ceramics is the largest tile manufacturer in the country today. Fine Organics is a leader in additives. Jubilant Foodwork is leader in the QSR segment. And CDSL, as we all know, is the largest security depository company in the listed space in the Indian market. But most of the names that I'm sharing with you right now are still mid and small cap as far as the market cap goes. And that is where we see the next opportunity of investment and creating wealth for our consumers. Now, what has happened is through our research, we have found out that there are two possible outcomes if I buy a mid cap. It can either become a small cap or it can become a large cap. Now, how do we identify that whether it belongs to this segment or whether it belongs to the other side of the segment? And that's why I'm sharing few names. Again, for the sake of disclosure, this is neither a recommendation of buy, neither a recommendation of sell. Few of the stock that I'm recommending, I'm going to use in terms of the examples, might be forming part of my flexi cap portfolio, which is already live, and might be forming part of my portfolio, which we are going to build for our ELSS category. But right now, this is being used only for the sake of giving you an example. Now, what are the common trades that we have seen for a company which becomes a small cap and for a company which becomes a large cap? Now, for a company which becomes a mid cap, from a mid cap to a small cap, have most of the time seen a very high level of debt in their particular balance sheet, or either don't have a proper cash flow management, either don't have a right governance structure of the board in place, or they have very, very less entry barriers, and the growth of the company in terms of top line and bottom line was not sustainable, or they might have a regulatory overhang. But on the other side of it, the companies which I just shared with you, which turned a large cap from a mid cap, were rightly placed with the right kind of corporate governance, with very, very low level of debt, or let me put it, debt-free companies. The cash flow was very, very strong, and they had very high pricing power and the product philosophy, and they've created the right moat and an intangible asset through which the valuation was sustainable for a long period of time. How do we identify at this level which are the companies that forms part of the left side and which are the companies that form part of the right side of the chart, which I'm sharing with you? Now, we, at the end of the day, what we are saying is typically the difference between both the side is quality. If I have to put everything in one word, the answer is quality. Now, how do we judge and how do we find out which are that quality companies to invest as on today? Our own model, which we called as Hexasil framework, is capable enough of identifying them, because we vet all the listed entities of the world on these 6 strict parameters and tests. The first and foremost is the reinvestment growth test. Here we see whether the growth of the company is sustainable or not, and whether the growth that company is sustaining, is it reinvesting for the future growth? So typically what we want is a 20 to 25% return on capital employed business and a very high reinvestment rate. We also check whether the regulator for that particular industry that we are scanning is an impounder to the growth, or is it also helping the company to grow in that particular segment. The third thing that we test the companies are on competitive advantage. What are the advantages that this company has in terms of its pricing power, in terms of its product philosophy, and also the way it has been placed, and in terms of its brand awareness. Now, just to give you one example, TCS being a 48% return on capital employed business, if I put it under competitive scenario of stress, where competition goes up and the margin comes down, on the highest level of stress, the company still reports a 32% return on capital employed, which is still above our benchmark return on capital employed that we want to invest into. Corporate governance and leadership test. Here we check what are the composition of independent and dependent board throughout the company, and what similar decisions that the same person has taken in the board of some other company, and we do like to like marking. And that's how we came to know what are the scores that we give in terms of corporate governance for that particular company. In the cash flow test, we see if at any point of time, if a company is showing the higher sales, but it is happening at where the receivable is coming after 30 days and 60 days and 90 days, that is what we typically don't want to see. We want to see what is the company doing in terms of cash flow, and we want cash cow businesses. And in terms of balance sheet, we want to see what are the debt levels, what are the other parameters that we see during the balance sheet test, and whether the company is fit for the long-term growth or whether it is going to be only a short-term growth for that particular company. Now, when we do this particular 6 test, and we run this test on 67,000 quoted entities of the world. Yes, you heard me right. There are 1 lakh listed companies across different exchanges in the world, out of which 67 to 68,000 companies are quoted on a daily basis. Now, when we run this test on all the companies across the world, because that is the kind of data that we get on a daily basis, on a weekly basis, we get a universe of approximately 180 companies which passes our Hexashield framework. 85 odd Indian names and balance global names. Now that 180 companies that passes our test becomes our investable universe. What we look out for the investable universe is a very high return on capital employed. As I explained it to you, we want a 20% to 25% plus return on capital employed business. We want a very high reinvestment rate so that the compounding factor is in place. We adjusted for the intangibles and the investment that has been made to build the future growth for the company. And all these things should be sustainable at a particular rate. Only then it becomes the holy grail of investing for Samco. Now, what are the businesses that we are looking to invest into are typically businesses which are into B2C space. We want products and services which are of regular use, which has repeat purchase requirement. We want a very high growth and reinvestment category. We want categories where the companies are creating intangible assets for themselves. They are creating that brand. They are creating that market recognition. They are creating that market share because of the sheer intangible that they have created. We want a very, very high laser sharp focus from the management. We don't want conglomerates, and we want a good level 5 leadership program so that there is sustainability in terms of people governing the board and taking the company ahead. Now, there are a few names that I'm going to share with you. Again, for the sake of disclosure, these are not recommendation for buy or sell from our side. These are just for the sake of giving you an example that this is the kind of wealth that this kind of companies has created, being in the mid-cap and small-cap space over the last decade or so, where the prices of companies like Page Industries has grown by 32% CAGR and is right now available in terms of its product presence is more than 120 odd countries, where we have seen an impressive 19% CAGR growth in revenue over the last decade. Companies like Kajaria Ceramic, which has nearly 10 to 12% market share in the tile business in India, is right now selling its product through almost 1,700 distributors, and which has clocked a more than 10% CAGR return in its revenue over the last decade. But the market cap has gone up by almost 30%, where the market cap has gone up from 1,400 odd crores to closer to 15,000 crores now. For companies like Fine Organics, we have seen a very, very healthy 53% CAGR return in the past 3 to 4 years. It is right now available, which is clocking a 16 to 17% kind of a CAGR return in its revenue, but the price has seen a 53% CAGR return in the last 5 years. Still, the market cap as on today is closer to only 22,000 crores. Another company that I want to share with you and take an example, which you all must be aware of, is a company called as PI Industries. Has a very, very significant market share in the crop production market, has clocked a turnover or a revenue CAGR return of closer to 18%, but the price performance has shown a 40% CAGR return over the last decade or so. Another company that I want to share, which is also forming part of my FlexiCap portfolio, JB Chemical, where the market cap is still less than 15,000 crore. And if you want to play a domestic brand for the formulation companies and growing very, very fast, then JB Chemical is one such name, where the top line is also growing very healthy. The bottom line also is growing very healthy. But in the past decade, it has created tremendous wealth for the investors, where it has turned himself from a small cap, which was having only a market cap of 600, 700 crores 10 years back, to only 15,000 crores now in the last whole decade. Another company, if you want to play the EV segment in India, LTTS, where we have seen a major correction in the IT segment over the last 1.5 year, still at this point of time shows a 40% price performance in terms of CAGR returns. Vinati Organics is another company that I want to share with you in terms of an example, as a very healthy 14-15% CAGR in its revenue, but has created a 44% CAGR return in its price performance over the last decade. Balkrishna Industries is another example, which is also forming part of my FlexiCap portfolio as on today, but has a market cap of less than 37,000 crore as on today. On the other hand, if you remember the names that I shared you, where a lot of mid-cap, which was one fancy name at one point of time, has destroyed a lot of wealth. And because of the reason which I shared you earlier, the companies like Future Retail, MMTC, Suzlons of the world, which are the type of companies which we typically want to avoid. And how will we avoid this particular thing is by using our technology, which is ELSS technology, which will tell us whether the companies are passing that 6 parameters or not. And if not, then they are not going to be part of our investable universe. Now, once we have identified the companies that we want to invest into, the other thing that is very important is to know at what price we want to buy them. What is an efficient price? Every stock in the market is good, but at a particular price, not at all prices. So how do we identify what is a good level to buy them and to stay and stick with this kind of a strategy? We have another technology where we value each and every company based on the free cash flow yield. So what we do is we typically adjust the free cash flow yield for R&D, discretionary marketing and technological development cost, and we come to the free cash flow yield of that particular company, and we see what is the free cash flow yield of the broader index, let's say Nifty 50, and then we know what is the premium that we are paying to acquire that particular stock. So we are okay paying a particular premium, but we are not okay to pay a premium which is far higher than the average premium that we want to pay for a particular stock. So in a nutshell, what we are saying is that we will try to enter the company which shows very high compounding ability through our Excel framework. We also want to see at what valuation we are buying them. So through free cash flow, we want to know at what price that we are going to enter. And we want to make sure that they are relatively a very strong performer if we are holding that particular company for the next 3 to 5 years. Also very important to then understand is till when we want to hold this particular company or what is the level at which we want to exit, because there is going to be very active monitoring of this fund. First, we have laid down a 5 strict criteria on which we are going to exit a particular company that we have bought. The first criteria and foremost criteria is if the test through which we found that this company was compelling hexasil test, if it fails on any of the criteria subsequently after we purchased it. So that is first reason why we will exit this particular company. The second is if we find a compelling opportunity outside, because it is going to be a strict 35 stock portfolio. So there will be not space for any 36 company. If the 36 company has to enter, then the 34th and the 35th company has to show more compelling opportunity to stay invested in our FlexiCap category. The third and a positive way of trimming that particular exposure is if I bought at a 4% exposure to any particular company, but because it has run up, it goes to 10% of my portfolio, where SEBI says that I will have to curtail my exposure. So I cannot have a higher than 10% exposure to any particular stock. And then that will result into exiting some stock for that particular purpose. We will allow that mid cap to become a large cap, and we will not buy a company when it has become a large cap or a mega cap. But the journey from a mid cap to large cap is what we want to typically tend to be part of that particular company. And if the 35 companies that I have bought, if there is somebody which is very significantly showing any terms of relatively underperformance in terms of his price performance or in terms of his fundamental performance, that will lead to an exit of that particular company. So the exit criteria is also very strictly defined for our portfolio. And that's why we will have a very efficient turnover where we will allow a mid cap to turn into a large cap. But if we find a better opportunity in the universe, we will not take a second to change that particular strategy. Now, for a predominantly mid and small cap portfolio, if you remember my FlexiCap portfolio, we have a 25 stock portfolio. But for a mid and small cap portfolio, because we have a very India specific portfolio, because there is no geographical diversification here, we have considered the liquidity of that particular company, because we are predominantly going to be in a mid and small cap portfolio. The volatility that comes because of the mid cap and small cap and the business risk that we hold, we have decided that scientifically that number should be 35 and not 25. So if I divide the entire 35 stock, that the average portfolio weight for one particular company will be less than 3%. The average market cap of the companies that we are looking to invest into is closer to 28,000 crore. So typically they are not the companies which has a very, very low market cap. 20 to 30,000 crore is the average market cap of the company that we are looking to build the portfolio for our clients through the ELSS mid and small cap portfolio. So if I have to summarize everything that I've said so far, it is going to be a strict 35 stock portfolio. They are going to be efficient companies which are being tested through our Hexasil framework, which is our own proprietary company framework. And we are going to typically invest only into quality stock. It is going to be predominantly only mid and small cap businesses. There will be no large cap when we begin this particular fund. It is going to be very, very actively monitored and strictly going to check the entry and exit criteria, which I have shared with you. We are going to hold our winners and allow it for all the mid and small cap to become the large caps of tomorrow. Another thing that I want to share with you, that at the end of the day, a 3-year lock-in period for a ELSS category and giving a mid and small cap portfolio is the best solution that we have found through our understanding. And that is what we are going to offer to the client, to create a 3-year rolling basis where we can give them a superior risk adjusted return. As I shared with you all the data points so far in the presentation. Now, as far as the ELSS tax saver fund goes, it is going to open on 15th of November. The end date will be 16th of December. We are going to give the allotment of 22nd of December. It is going to reopen for subscription on 29th of December. And the benchmark for this particular index is going to be Nifty 500 TRI. Now, who are the people governing the board? Who are the people running the show for us? We have G.N. Bajpai, as you all know, is the former SEBI and LIC chairman. He is the chairman of our trustee group. We have Prabhat Kumarji, the former cabinet secretary and the first governor of Jharkhand, also forming part of our independent directors of the trustee group. We have Shailesh Gedia, another chartered accountant and former director of Punjab and Sindh Bank. We have Vipul Modi ji, who is the chairman of Samco Group, also a young rank holder chartered accountant of India, and the non-executive director and associate director of the trustee group. As far as the AMC group goes, we have the chairman Ashok Kakkarji and an independent director, the former ED of the SEBI. We have another gentleman called as Ishwar Naik ji, who is an independent director and also CA. Kanu Doshi ji, non-executive director and associate director, and he was also a chairman before joining our board for the chairman of Nippon, Motilal and Edelweiss AMC. And another rank holder chartered accountant and the CEO of Samco Group, Jimit Modi. So these are the 4 directors on the Samco AMC Group. Now, the people governing the board also has a team of managerial personnel, and that is when so the first person is myself, Viraj Gandhi, who is going to be the CEO of Samco Mutual Fund. We have Umesh Kumar Mehta, who is going to be our CIO, Chief Investment Officer, has a very, very varied experience on the research side. And he is also a veteran on the stock research side. We have 2 young and energetic fund managers in the form of Nirali Bansali and Dhaval Dhanani, who is also a CA and forming part of my board, which is going to be on the managerial side. It's going to be predominantly in mid and small cap index, and it is going to be a lock-in for the next 3 years, and the Nifty 500 is going to be the benchmark TRI. So that's it from my side, and I'm open to questions if I have any. Over to you, Chirag. Thank you very much, guys, for your time and effort.
Thank you, Viraj, for the wonderful presentation. To the audience, you can ask your questions in the Q&A section, and I will take them up one by one. The questions have already started flowing in. Okay, there is one question on the benchmark, which is Nifty 500. If portfolio is going to be only mid cap and small cap, why the benchmark NSE 500? It does not match the stated strategy.
So we are governed by the laws, and the regulator has told us what will be the benchmark. So that is not been selected by us internally, but that is been governing. So SEBI has decided what will be the benchmark, and it has not been decided by Samco. Ideally, one should ideally. So let me give you a little longer answer, Chirag, on this.
Yeah.
Ideally, we want to track Nifty 50, and internally we do that. But as far as the benchmark goes, Nifty 500 TRI is going to be the benchmark that we are going to be compared with.
Correct. There's one question from Mr. Ajay, and I would summarize the question because it's a long one. So, in short, he wants to know more about our fund managers, their experience, and what funds they are managing right now. So, would like to take that
So
question.
so as I told you, we are governed by the board first. Second, we have an investment committee. So there are 5 people who are part of the investment committee. Myself, I am the CEO of Samco Mutual Fund. I have completed my MBA in capital markets from NM University. I started my career as research analyst with ICICI Securities and then with ASK Investment into portfolio management. For the past 10 years, I am with the Samco Group. I joined as a co-founder and chief business officer of this particular AMC in 2021, and now I'm being promoted as the CEO. We all come from the market background. Jimit Modi, who is the chairman of our investment committee, is a rank holder chartered accountant, CFA. He has done a couple of degrees from IB League and a very, very dynamic guy. If you get an opportunity to interact with him, you will definitely learn something. He chairs the investment committee. We have Umesh Kumar Mehta, who is our CIO, has a market experience of more than 2 decades, is an CA, MBA from a very renowned university, was a CIO for a couple of family offices before he joined Samco Group. He is with the Samco Group and looking after the research for the past decade or so. We have Nirali Bansali, who was previously being the head of research for Samco Securities before she was being promoted as a fund manager at Samco AMC. Also has a very, very deep understanding of the market. She is also an MBA grad and she also has a couple of degrees and a very, very known person in terms of market understanding. She was also on a lot of media channels giving her interviews for Samco Group before she was being promoted over here. And Dhaval is also a very dynamic and young guy, forming the 5th guy forming part of my investment committee. And we also have Paras Matalia, who is the head of research right now for us, who is also part of our investment committee. So together, all of us has more than 100 years closer to 85 years of market experience in terms of the board that we have, in terms of the investment committee that we have. And that is why we are very, very sure that we will be able to take the right decisions for our investment and for our investors for all the portfolios that we are going to build over a period of time.
Okay, we have got a lot of questions, but I'll take a couple of them before we close the session. So there's one interesting question from Mr. Subramaniam. He wants to understand that how will this fund get stability without investment in a large cap stock?
So it's a very good question. So if I can just share my chart again, Chirag, just give me a moment.
Yeah.
So this is what I've said during the course of my presentation, and I will share it once again, that if it was only a 1-year product, which the question is about, then there is a lot of volatility. If you see this chart, is this chart visible, Chirag? If it is a short-term period, if it is for a short period, so let's say it's a 1-year rolling basis, we have seen a very, very high volatility for a mid and small cap index. And that's where typically the major challenge lies. But if we put this into perspective for a 3-year lock-in period, which is what my next chart will be overlapping this chart, the green chart that I'm showing it to you, the blue one is the 1-year volatility. But if you see the 3-year chart, see how drastically the volatility is subsiding. So for a 3-year lock-in period, it's one of the best products. As you rightly said, if it was a short duration product, then mid and small cap does not make sense to a lot of investors because the volatility typically is very, very high for a short duration. But if you just allow it a 3-year lock-in period, that's why I'm showing a 3-year rolling period comparison to a 1-year rolling comparison. You see the blue chart and the green chart. You see the volatility of green chart. It is subsiding quite nicely compared to 1-year rolling chart. And that's why that is one of the solutions that we are providing at Samco, that for a 3-year rolling basis and a 3-year lock-in period of ELSS, which is the category, which is the need of the product, mid and small cap exposure makes a lot of sense to the investor to create the wealth.
As a follow-up question from Mr. Shekhar, I know you answered this in the presentation, but if you could touch upon this, is that once a mid-cap company turns into a large cap, will it remain in your portfolio or will it be removed after it becomes a large cap?
So we will allow it to become a large cap of tomorrow. We will not trim our exposure because it is becoming a large cap, because the idea of having a mid cap is to allow it to become a large cap. But what I'm saying is, typically at that level, I'm not going to buy new shares. I will not buy anything new when it is already a large cap. But I will not allow it to be hindered in the journey from becoming a mid cap to a large cap. I hope that clarifies, Chirag.
Yeah. I'll just pick another interesting question. I'll take up, this will be the last question for the session, and then we'll answer all the questions offline over email. Okay, 1 second. What is the minimum EMOC score you will choose to, when you are investing?
So EMOC, this is a very different question. So EMOC is a number that we publish on our website on a daily basis. There will be anywhere between 1 to 200, 100 being the fair value. Anything below 100 means markets are turning expensive. Anything above 100, meaning markets are turning favorable in terms of investment opportunity. So whenever we see that number going above 100, okay, that is the time typically we want to start building our portfolio. And any number closer to 75, 80, we don't want to invest new money at that levels.
Got it. And one last question, Viraj, before we actually, end the session, is that, how long would you recommend to stay invested in the scheme? Is it 3 years because of the lock-in, or you would want, investors to hold the scheme for a longer term for a good return?
I will share one more chart with you. Similarly, what I've shared with you. If you see this chart, the ideal time frame for anybody to be invested in a mid and small cap is this number, 3 to 5 years. You see this chart and you see this chart. Anywhere, if somebody is somewhere here in between, you see the long-term performance of a large cap compared to a mid and small cap. See the wealth that this companies has created in the last 10 years. If you remember the 7 to 8 examples that I took in my presentation, I have shown a 10-year CAGR return of that particular stock and the kind of wealth that it has created. So anybody who has a 5-year plus horizon and has a capability of holding it for even longer, the kind of wealth that these companies will generate will be massive. A 20 to 25 or a 30% CAGR return, typically in the world of investment, this is called as the 8 wonder of the world.
Got it.
Any businesses that can give you a 26 to 30% CAGR return over a decade, we have seen many examples in the Indian capital market, and they are the favorites of everyone as on today. The Bajaj groups of the world, the HDFC's group of the world, which has created massive wealth for investors. They are all about 30% CAGR return in terms of price performance, in terms of top line and bottom line CAGR performance.
There are a lot of other questions that are overlapping. So to the audience, I've covered certain questions that actually answers a lot of other questions, also sub questions. So I think that is all from the Q&A side. I would, on behalf of the whole Samco Mutual Fund team, I would like to thank you. And I really appreciate that you were patient listeners and you held on for till the end. Thank you so much. And for any more information that you may require, you may visit samcomf.com. Thank you so much.
Thank you guys once again for your time and allowing us to completely come out with differentiated strategies, and the support that you have given us so far in our FlexiCap category. I'm expecting all of you to provide the same or even higher support for my ELSS scheme, which is going to be a differentiated product, which I have explained it to you, and also through the advertisement and the kind of branding that we are going to do in terms of our marketing effort, which you are going to see over the next few days of time. So thank you once again, and looking forward to your active participation for my NFO, which is beginning on 15th of November for a month. Thank you guys once again. Thank you everyone.
Thank you. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.